What's up, everyone? Welcome back to another video. This is Major Tom. I'm your host for International Investing YouTube channel. I'm also the CEO of International Investing, a hedge fund based out of New Jersey. Um, Look, we don't make any money on basically any ad revenue from YouTube. We don't make any money on anything else like that. We don't sell merch. So if you could, please just drop a like on this video and put some comments for the algorithm. I put a lot of time and effort into making a video series that would explain kind of like how our fund trades and kind of the strategies that we like to abuse that are very profitable for us. So I'm going to break this video up into a few parts and make it a series, one of the first informational series on the channel. So without further ado, let's get right into the content. All right. How to Trade Spreads, this series by International Investing, of course. So we'll start with options because you have to understand what an option is in order to sell spreads. So um, there's always an option buyer and an option seller. So in order to sell an option, you have to own 100 shares of the underlying, or you have to own 100 shares of stock. In order to buy an option, you don't have to own any stock. You just have to buy the. You have to put up the premium to buy it. So basically, you have to put up the cash to buy the options contract. And what an option is it sells the right to buy or the right to sell 100 shares of stock at a certain price. And, if you're looking for the right to sell a stock, it'd be a put option. If you're looking for the right to buy a stock, it'd be a call option. Buying a put is a bearish transaction, and buying a call is a bullish transaction. So this is Option Strategy. Option Strategy is a website that we use in order to break down our trades before we make our trades and kind of determine how much risk we want, how much returns we want, and what our break even is, and a bunch of other things like that. So it's a very, very useful tool. It's not necessary for trading, but I think it's definitely worth the whatever. I think it's like $10 a month if you pay for the year. But regardless, let's break down buying options for a second. So if we were to buy this June 2nd, so right here is the expiration. So because it's highlighted on June 2nd, that's 24 days away. This contract expires. If I was to buy this contract, it's going to cost me $168. My max loss is $168. And my chance of profit is only 37%. Whereas my how much profit I can make is infinite. When I buy a call option, the stock could go to infinity price and I could make infinity profits. So yeah, that's basically buying options in a nutshell. You only have a 37 chance of profit. Now selling options is like the opposite. So if I was to go ahead and sell the same call on the same stock, I now have a 63% chance of profit, and my maximum loss is infinite. Because I'm shorting a call option, right? If the stock just keeps going up and up and up and up, I'm exposed to that upside risk infinitely, right? So selling options nakedly is very, very dangerous and risk adverse. This is what a spread looks like. So if I was to take a bear call spread, so if I wanted to basically short an option, like the $9 call, if I go long the $10 call, I prevent myself from infinite risk to the upside. Now my maximum loss is only $80, but I also cap my profit. My maximum profit's only $20. Why? Because I have to pay for the premium on that long $10 call in order to cover my upside. My chance of profit on this trade, however, is now 72%, and my risk, or my max loss, is now mitigated. This is why we like to trade spreads. Also, the amount of money that I need to make this trade is only $100, which is your estimated margin over here. So if we break this down, the spread requires us to tie up $100 of margin to make up a $20 maximum return on the expiration date, which is only in 24 days. This nets us a 20% return on investment because we invested our $100 for 24 days maximum to make this return. Most people make 10 to 14% trying to invest in ETFs and indexes every year, and we make more than this in less than a month, literally 24 days till expiration. When this contract expires, it's going to expire worthless, and we get to keep that $20 net credit. So there are some other alternate spreads. We're going to touch on them. Some of them we actually use, some of them we don't. So the first one that we're going to touch on is the butterfly. If you take a look at the butterfly, you have to short a 6 put and short a 6 call, and then go long on the below it and above it. So essentially, the closer you are to $6 when this expires, the more money you make. Your net credit on this is $200, and your max loss is $50. Which is a really, really good risk-reward profile. However, you only have a 37% chance of profit, which is the problem with the butterfly. The butterfly is really, really good for when you know a stock will stay pegged to a certain price target. However, we don't like to use these because the chance of profit is so low. 37% win rate is not something we like to trade consistently. There's another kind of alternate spread called the iron condor. Iron condors are essentially when you open a bull put spread on the low side of the stock, and you open a bear call spread on the high side of the stock, and you essentially trap the stock between the two between the short put and the short call. So as long as the stock stays between these two, you make money, and both options expire worthless, and you basically keep the premium. Iron condors are great. It's the equivalent of taking both sides of the trade by opening spreads on both sides of the price action. The chance of profit on this trade is still 70%. It's above 60%, and the maximum loss is limited to only $100, which is pretty good. And iron condors and bull put spreads, bear call spreads are the main strategies we use. At International Investing LLC, we have different parameters that influence when we use each strategy, and we're going to go into the parameters kind of in a later video further down the line. So that concludes part 1 of the video. Thanks for tuning in. That kind of explains what an option is and the different spreads that we use. And then in the next video, part 2, we're going to be talking about the pricing of contracts and how the pricing on contracts is actually determined and how we can sort of abuse some options variables. So thanks for tuning in, and be sure to check out part 2.